Hello, Professor,
And
and everyone. Today we will present the two cases. They are Nike and WRIGLEY. Our group have 6 members. Firstly, beginning from the Nike case, came forward, our portfolio manager at North Point Group was sensitive with analyst write-ups of Nike. Nike management wanted to improve trade growth and operating performance. Ford cared whether it was worthy of investment. Therefore, the KME team immediately gathered all the data and began to analyze the future value of the Nike. Since Nike is bounded with debt and equity, the WACC is the most important for the investment. Cohen, the analyst member of the KME team, gives the calculation like this. But in my opinion, it exists two gaps of the cost of the equity. First one is the current yield. Because of the forecast of the following 10 years, I think we are preferring the 10-year treasury bonds as a risk-free rate. It is more appropriate to use this value. The second one is the beta value. Because the beta value indicates the past period's systematic risk, it isn't necessary to recalculation. So I use the latest beta value. Eventually, the cost of equity of the revision result is 9.5%. WACC is 7.7%. Okay, next part is of Aman.
Okay, yeah. So I'm going to talk about the calculation using CAPM and also dividend discount model to determine the WACC. Right. Next slide, please. Okay, so on the left side here in the blue color, that one is using the DDM. And we found that the WACC for using the DDM is 6.42%. So the advantage for DDM is actually it's more towards it's good for companies with stable dividends payout. And then it is suitable for a more mature company or industry, and also it is simple and long-term perspective rather than a short-term approach. And the indicators that are being used here to calculate it are useful to determine the required rate of return. But the disadvantage for this one is actually the high assumption on dividend rate and growth rate, which might be a double-edged sword. So it's not really suitable for companies with unstable dividend payment. So in terms of Nike, it is good that we use DDM. All right, so for CAPM method, when calculating the cost of equity, it is you can see that when the cost of equity is 9.81, using the 20-year bond deal, the WACC is 9.27, and then when we use the 5-year bond yield, the cost equity is 8.95, and then we get WACC about 8.49%. And then the third one is if we use 1-year bond yield, using the cost equity of 7.66%, the WACC is 7.33%. So for WACC, the advantage for this is that it's good for companies with unstable dividends, and then it is simple to use with publicly available data, which only requires companies' beta and standardized method, which can be used to measure across industries. And then the cons for this one is that it assumes the market is always efficient, and all information about the company is publicly available, which is not true most of the time. And then one more thing is that it uses historical data which might be updated and ignore other types of risks such as unsystematic risks, liquidity, and operational risks. All right, next slide, please. So the recommendation to Kimi Ford is that by using the CAPM method and DDM method, we calculated that it is highly recommended for Kimi Ford to invest in Nike and add Nike into the North Point large cap fund, as the Nike price is actually undervalued and estimated to grow in the future. All right, I'll pass next to WRIGLEY case. Thank you.
A rare borealis is the hedge funds with about $3 million on the major in June 2022. It was considered the post gain from the increases data capitalization of the WRIGLEY company. WRIGLEY had been conservatively financed under data of the case carry no data. So its master gauges the value shifter through adjust the present value analysis for WRIGLEY potential re-leverage. This is involves the sensible impact on the winter of which the cost of the capital earning per share from the creator rating and the region family voting the control. It's also needed to evaluate the advantage of the other dividend or share purchase mechanisms for return the cash to shareholders. The next. The current WACC is the WRIGLEY is the 10.9%. Since the is all equity from the WACC is the same as the cost of equity, rising $3 billion data for the repurchase of stock or dividend would change the capital structure of the firm. In our case, the WACC after including the data structure almost reminds the same 10.9 to 10.92. The reason of this change is the increase the beta 0.75 due to in level and the new data level, which brings the beta up to 0.87 to the same level and the relevant data ratios. So those relevant show no effect on value of the firm. The stock price rise due to the repurchase. The next. The instructor of the data case an 18% decline in net income linked to the reduced dividing the per shares of the $0.5 with the $3 billion data insurance. The EPS dropped from the $1.612 to $0.04 with a share repurchase and $0.15 with a dividend. Although the overall negative impact on EPS of the capitalization repurchase the share yields the high EPS value than dividend based recapitalization and EPIT value of the $530 billion. $356 million. The total market value of the equity after the recapitalization is the 11 billion $302 million. Equivalent to the market value if from the of the dividend instead of the share repurchase. Thank you. That's all. Next.
Okay. Then it's about matches of dividends or share buybacks as a means of returning cash to shareholders in this case, signal stability. It means WRIGLEY has sufficient profitability to support dividend payments, share buybacks. At the same time, share buybacks may be seen by the market as a sign that the company's shares are undervalued, which may boost investor confidence in the company's prospects and then attract more quality investors. And then flexibility. Stock repurchase provide a more flexible use of cash. WRIGLEY can adjust the timing and amount of repurchase based on market conditions and its financial situation. Earning per share growth. Stock buybacks may increase earnings per share because the same amount of earning is allocated to fewer shares. It can be quite attractive to investors who are concerned about per share performance metrics. Okay, next slide, please. Okay. About if what is the managing director of the huge fund hoping to accomplish through her active investor strategy? We think Blanca may want to achieve specific financial and strategy goals. First one, of course, it is maximize returns. In general, an active investor aims to generate high returns by actively managing their portfolio. They may conduct in-depth market research and company analysis to identify undervalued and overvalued investment opportunities. Meanwhile, they may have the flexibility to adjust their assets allocation once there are some changes in the market and the industry. Then to find alpha by identifying deficiencies or value basis in the market. She may seek to generate alpha. They can generate returns in excess of market average. Then manage to manage risk. While seeking high returns, the active investor also focus on risk management. As an active investor, we think they may protect the fund from market volatility through active risk management to ensure the robustness of portfolio. Last one, to take the advantage of market volatility. She may try to seek investment opportunities through the flexibility to take advantage of a market volatility. Both in up and down market. Okay. Next, please.
Okay. For recapitalization, right, by issuing 3 billion of new debts to pay the dividend or to repurchase share, For outstanding share, the impact of share for dividend is no changes, but the outstanding for share repurchase, they will reduce the common share outstanding to 183.69 million. For book value equity, the 3 billion debts dividend leads to the drastic decline from 1.276 billion to negative 1.724 billion. For both dividend and share repurchase options signal the fundamental shift in the financial conditions will be reducing. But for price per share, debt for dividends lower the price per share to $48.6. For share repurchase, actually they will increase the price of the share to $61.53. So it's more available to increase the share value, and the capital structure intricates the influence market valuation for the share price. Next. For earning per share for EPS, right, debt issuance for dividends decrease EPS to 0.12 cent, and share repurchase for a varied EPS reduction, highlighting diverse probability impact. So debt interest for coverage ratio and financial feasibility, 3 billion debts trigger 390 million interest payment, resulting in 1.35 debt interest coverage ratio. So credit rating will be downgrade, poses a risk and impact financial feasibility for this company from the AAA to the BB rating. So voting control by the WRIGLEY family, if they are using the dividend distribution, they will maintain the WRIGLEY family voting control. For share repurchase also, the family still have a controls aligned with their interest in corporate governance. So conclusion, the WRIGLEY recapitalization journey, if they are pay for dividends or they purchase a new share, there's a strategic decisions balancing debt equity and governance. The repercussions reverberate through operation, emphasizing the needs for the judicial approach to financial restructuring.
So to conclude everything, should WRIGLEY's directors undertake the recapitalization? After careful consideration of the risks and benefits of the recapitalization of WRIGLEY, we recommend that the board of directors should undertake the recapitalization. As WRIGLEY does not hold any debt, financial value would be added as a debt tax shelter would be created, by which WRIGLEY would be increasing its debt to equity ratio. After recapitalization, WRIGLEY is expected to have higher net income in comparison to before the recapitalization. A share repurchase will cause the company's stock price to increase from $56.37 to $61.53, thus creating value for shareholders, while paying a dividend will cause the stock price to decrease to $46.63. WRIGLEY would have more voting control as the portion of WRIGLEY stock would be greater after the recapitalization if the loan is used to repurchase outstanding shares. In addition, there is a minimal change to the value of WACC, but it is very minimal, so it is still recommended for them to consider the recapitalization. The downside of this transaction is that the earning per share will plummet after the transaction, and even though the credit ratings falls to BB rating from AAA, it denotes moderate prospects for ongoing viability for WRIGLEY. From this, we learned that even though there is a downgrade on credit rating, WRIGLEY will still be able to meet its financial commitments. Therefore, the management would have to pay close attention to WRIGLEY's expenses after recapitalization in order to maintain good cash flow and generate better credit ratings in the future. So after considering the pros and cons, benefits still outweighs the disadvantages. Therefore, we recommend for WRIGLEY to consider the recapitalization. Thank you.
Thank you.